All right, so in this video, I'm going to talk a little bit about the maximization of shareholder wealth. So I'm going to argue that the primary goal of financial management is to maximize long-term shareholder wealth. And the basic idea behind that is that the shareholders are the owners of the firm, and therefore the financial manager and the CEO and so forth are basically employees of the shareholders. They're working for the shareholders and for essentially the benefit of the shareholders because it is the shareholders' resources that they are using. And so therefore, they're trying to make or should be trying to make decisions that are in the best interest of shareholders. Now, it is important to note, as sort of a side note here, that does not mean that the interests of other groups don't matter. Interests of employees do matter, interests of customers matter, and so forth. And one sort of broad view of this idea of trying to maximize long-term shareholder wealth is that in the long run, being mindful of the interests of employees and lenders and shareholders and customers, basically all of those different stakeholders. Notice the use of the word stakeholder, not stockholder. That being mindful of all of those interests will be important for the long-term profitability of the company. So, as sort of a basic example, if you churn out subpar products, that may look great for a period of time for the shareholders, and that they can make all kinds of money on selling these products that cost a whole lot less to produce. But that's bad for the consumer, bad for the person who's buying the product, and eventually, in the long run, this is going to turn out to be bad for the shareholder too, because they're going to get lawsuits over the subpar products that fall apart, or people just stop buying the products, and ultimately that would be bad in the long run. So the idea is that there is kind of a connection there. But from my perspective, we're sort of wrapping all that into this. And the idea is that the primary goal of the financial manager is to maximize long-term shareholder wealth. Now, that does lead to some interesting issues as it relates to trying to measure that, or how do we gauge that? So we could look at just like total profits, right? So if I look at total profits, if the amount of net income is going up, then that looks great, right? But there are some problems with that. What is the risk associated with those profits? If the profits that are involved are extremely risky, or the risk is very high for generating those particular profits, then that's going to become a problem, right? So that's an issue. Also, what about time horizon? Maybe the company is making a whole lot of profits much further down the road. Well, a dollar earned 10 years from now is not worth the same amount as a dollar earned tomorrow, right? So we have to be kind of mindful of, well, if we're talking, we want more total profits, like when are these total profits happening? Because that's going to affect things. Then also the number of shareholders. If I just sell a whole bunch more stock, increase the amount of money that I brought in from shareholders, and I just increase the scale of the business, I could perhaps get more total profits, more dollars of profits. But it wouldn't necessarily be better for any individual shareholder, right? So because I could have so many more shareholders that I've increased the amount of profits, but I'm splitting it across so many more shareholders that it might actually even be worse per shareholder afterward. So I have to be a little bit careful about using something like total profits. Well, if I'm thinking about that and realizing that there's some problems with total profits, well, one possible solution here would be to say, all right, well, we had a problem with the number of shareholders, so let's do earnings per share. So let's take the total amount of profits divided by the number of shares we have. So now I'm kind of eliminating that number of shareholders or number of shares outstanding kind of a problem. We're going to look at it on a per share basis. And the good side is, all right, well, on that standpoint, if I sell a bunch more shares, well, that increases the number of shares, but that's going to be reflected in the earnings per share. So I'm looking for, am I increasing the earnings per share after I sold all those shares and invested in my business or what have you, right? So I've probably kind of moved around the number of shareholders, or number of shares more precisely, problem with the earnings per share issue, but I still have other problems. I still have that risk problem. What's the risk associated with those earnings? Because I could take a lot of risks as a business, and if they pay off, then my earnings per share go way up, right? And so that could look great until it doesn't, and something goes wrong. And so if it's really risky, then that's a problem. And we still have that time horizon issue too of, maybe I'm increasing earnings per share, but when am I increasing the earnings per share? So I need to be kind of mindful of that. So the best answer really is probably the long-term price of the common stock. So if we're trying to maximize long-term shareholder wealth, really what we're looking at is, can we maximize the long-term price of the common stock? So that's probably the best answer. Now, even with that, there's still kind of a little bit of maybe a fringe case problem, and that would be, what if it was just better for the company to liquidate itself and to return the money to shareholders? What if they are in a dying industry and they don't have any significant strategic advantages that they could pivot into something else? And basically looking at the assets, like it's just flat out more valuable to just take those assets, sell them off, take the proceeds after all debt and liabilities have been paid off, and just return it to shareholders. Now, I wouldn't expect that to necessarily be common, but it's a possibility that if I'm trying to act in the best interest of shareholders, it's possible that a company could have a situation where, you know what, it's just flat out better to just return the money to the shareholders and move on, right? So that's a possibility. Now, if we're kind of going with the long-term price of the common stock is sort of our best way of measuring how we're doing at maximizing long-term shareholder wealth, then that leads to some interesting follow-on issues. So if, that's a big if stock price is equal to value in the long run, okay, so in the long run, if stock price and value track with each other, then basically what this means is if I want to maximize stock price per share, I need to maximize firm value per share. So I need to do that. So if that's the case, how could we maximize firm value per share? So basically, if you think about how to calculate firm value, it inherently comes back to basically two things. One, future cash flows, and two, the discount rate used. And the reason for that is the value of any asset or investment is the present value of all expected future cash flows. And I'll say that again. The value of any asset or investment is the present value of all expected future cash flows. So if I want to find the value of a stock, I need to figure out what are the future cash flows that we're expecting. And if I need to find present value of it, I need to find an appropriate discount rate to use to find the present value of that. So that's pretty much, at the end of the day, what valuation comes down to. What are the cash flows and what discount rate should I be using for those cash flows? So with that in mind, if I'm thinking about those future cash flows, I'm trying to maximize the value of the firm and thinking about that. So one problem we have is how predictable are these future cash flows, right? I mean, do we really know what they are? And the reality is, well, it's in the future, and I don't know the future with certainty. So if I don't know the future with certainty, then well, things might not work out the way that I thought, right? So predictability is kind of a problem. Now, some businesses might be in more predictable industries or sectors than others. Maybe they've got guaranteed government contracts or something like that that makes it a lot more predictable. Other businesses, it could depend an awful lot on what's going on with the economy, what's going on with consumer sentiment and so forth, and whether the consumers are feeling like they've got extra disposable cash or not. So it's going to be pretty much varying. That's going to be a little bit of a challenge there. Also, when trying to figure out the appropriate discount rate, well, we have problems with that too. Well, first off, if I'm trying to figure out discount rates for future cash flows, what might inflation look like? Or what might interest rates look like in 5 or 10 years, right? And on top of that, not only just the inflation and interest rates and things like that, just for sort of the economy as a whole, but also how risky are these cash flows? Because the riskiness of the cash flows and therefore the kind of the riskiness of the business is going to influence what kind of discount rate we ought to be using. So I need to be thinking about, well, what do I think might happen with inflation, interest rates generally, riskiness of the cash flows? So I got to think about all this kind of stuff now. And the reality is we don't know any of it with certainty, so that's going to be a bit of a problem. Now, we also have kind of another problem here, and that is if we're trying to maximize long-term shareholder wealth, which is generally linked to the long-term price of the common stock, we're thinking long-term price of the common stock should track with the value if basically the markets make sense. That's perhaps a topic for another video. And so that kind of gets to, well, what if they don't? What if price and value are not the same? What if they happen to deviate for some reason? Well, some of the reasons why they could deviate would be things like fear and greed and behavioral biases generally. So if people get really fearful, then they may not want to invest in anything at all. And the value could be fine, but the price drops quite a bit because nobody wants to invest because everybody's scared. On the other hand, if everybody's getting greedy, the value might be here, but everybody's so greedy and so optimistic that they're willing to pay way more than the value, and that's going to end badly. And that's a general principle of business. If you pay way more than something is worth, it ends badly, right? So if people get fearful or greedy, we could have some disconnects between price and value. And people could assess different investments poorly and based on a whole bunch of behavioral biases and things like that. So there's a whole area of finance about that, behavioral finance, which gets really kind of interesting. So from that standpoint, that could cause problems as well. But in general, what we're looking for is we're trying to maximize long-term shareholder wealth. Best way of looking at that is long-term price of the common stock, recognizing that there are some challenges with kind of figuring that out. All right, hopefully this video has been helpful. Thank you so much for watching and have a great day.